Let's start with the jobs report from last week. It increased the probability of a rate cut for December, and I believe that is mostly on the household survey. The establishment survey and the household survey are completely disagreeing with each other. Let's start with the establishment survey. A net gain of 227,000 jobs. Private sector creating 194,000 new jobs, government 33, which is 17% of the total. That is in line with the G component of GDP. Revisions, both positive. September revised up 32,000 to 255. October revised up 24,000 to 36. Strikes and storms kept that number down. Strikes and storms are over, so we bounce back to 227. A 2-month average, if the strikes and storms hadn't happened, a 2-month average sitting at 125.5. Average weekly hours, stronger. Average hourly earnings up 0.366, the combination of the two together. Average weekly earnings up 0.659. That is what is going to be heading to the malls of America for Christmas shopping. Diffusion index, services up 3, 56.2 in expansion territory. Manufacturing up 1.4, 47.9, still in contraction, but not as much. So if you just saw this, you would say, wow, positive revision, positive job creation. Government is not really carrying the load. 17% is in line with GDP, so private sector is in there. More hours per week, more earnings per hour, more weekly earnings. Both the services and manufacturing diffusion index increasing. What's not to like? Maybe the Fed can stay on hold. Well, let's take a tour through the household survey. The labor force actually shrank 193,000. There's a question mark there. What's going on? Participation rate dropped by 0.1 to 62.5. Job losses employed 355,000 less, from up 227 to down 355. Unemployment rate ticking up to 4.2%. U6 at 7.8%. Full-time jobs lost. Part-time jobs lost. The 16 to 19 category gained 102, but 20 to 24 lost. 25 to 55 lost. 55 plus lost. Less than high school gained. There's your Christmas help. High school lost. Less than college lost. College plus lost. If you just look at the household survey, you'd say, that doesn't look good. Maybe they need to cut 50 basis points. Unemployment's ticking up. This is curious. This is a phone survey based. Is something going on here ahead of the threat of deportations? Not trusting the phone call? How many people in the household? Oh, only 2. Meanwhile, there's 6. How many people working? Oh, just one of us are working. The one that is documented. The undocumented ones, maybe there's just some lying going on. How does the labor force shrink by 193,000 and the participation rate drops while you have population growth? I just find that a bit of a curiosity, that I think on this phone survey there might be some lying going on, saying, no, Jose is not here, Pedro is not here, none of these people are here, there's only 2 of us, and nobody's working. Maybe it could be something like that. Let's begin with duration. Look at our rates, money market rates and capital market yields. All of them dropped over the week, and you can see coming out of the 1 month 19 basis points, out of the 2 month 19, which is in line with the increase in the probability for December 18th, 10 days, 25 basis point cut, up from 66 to 85. Our slopes 2 to the 10 year still upward sloping, not really making headlines, but still upward sloping. And the 3 month to the 10 year, 13 basis points, inverted by only 27 now. Canada 27.9. Canada and the US almost have the same level of slope. So you can see what has gone on week over week with the curve. CPI we get in 3 days, another risk event for duration. PPI in 4 days. The Bank of Canada we get in 3 days. The expectation there is for a 50 basis point cut. And the ECB we get Thursday morning, we get in 4 days. reverse repo down to 130 billion on Friday. That is the lowest level of the reverse repo since balance sheet runoff began. Reserves down to 3.2 trillion. So the difference between the reserves plus the reverse repo minus what I think is the level of ample reserves, 2.5 trillion. 846 billion, that's 21 months of runoff, but the thinking is that by mid-2025, early, probably by Q1 2025, discussion of balance sheet runoff will start, and somewhere around mid-2025, it will end. That will add purchasing pressure to treasuries because they will be rolled over. So when a 10-year comes due, rather than having 15 billion runoff each month, it will be purchased. But MBS will still continue to run off. But if you have zero runoff and MBS runs off, you have even more treasury buying. TLT week over week 0.45, SPX week over week 0.96. I'll tell you, this thing over here, no news, it goes up. News, it goes up. Whether the news is good news or bad news. Good news, it goes up. Bad news, well, the bad news belongs to a different market, or the bond market, not the equity market. It goes up. It just goes up. We're over 23 times on the forward multiple. I'm jumping ahead of myself here. Effective federal funds rate is 4.58 for now. If we look at the futures curve for Fed funds rate, Q4 has got 22 basis points in there, Q1 negative 23, Q2 of 25 negative 22, and Q3 negative 14 for 81 basis points over the next 4 quarters. Well, I say the next 4 quarters, we're almost at the end of this quarter here, so let's call it over the next 10 months. 81 basis points, but there are 8 meetings over this period of time. December is pretty much a done deal for a rate cut. So 2025, 2 out of 7. I don't think so. Here's what I think the curve should look like. I think you got a rate cut for Q4. I think you get 1 rate cut for Q1. I think you get a pause, cut, pause. I think you get 2 rate cuts in Q2 and 2 rate cuts in Q3 for a total of 6. Not 3, so this should be negative 150, not 3. 5 out of 7, so October ZQ should be priced at 97. October ZQ is at 96.23 at this point. So I still think that ZQ is priced wrong. I still think that being long October ZQ makes a lot of sense. I think once we see the SEP and what the terminal rate for the end of 2025 will be, I think ZQ will get a nice bump up. And I still think the long end of the curve yields here still have some downward movement to it. The new Treasury Secretary seems to be concerned about the trajectory of the debt, eyeballing the deficit. Doge is saying we've identified $500 billion in 24 programs so far. Whether or not they can actually get it cut, I don't know, but they've identified $500 billion. So if you scream loudly enough at something, it'll start to get attention, and it is starting to get attention. So I think that that narrative can carry the momentum down. After the jobs report, TLT made a run for 95, didn't quite make it and came back down. The important thing was it didn't keep coming down. It didn't head down to a 90, heading down into 93, 92, 91. It held its ground. It didn't give up any ground. That on its own is promising, considering where we've been the last 6-7 weeks. All right, over to beta now. Looking at S&P 500, Friday's close 607.37 on SPY, all-time high. Again, another all-time high. Forward 4-quarter operating earnings down from the previous week, 263.36. Closing SPX up 69.27. That's a gain of almost 1% week over week. 23 times forward earnings now. 22.89 was simply too cheap. 23.12, and I'm sure By this time next week, I'll be saying 23.36, and maybe we'll hit 24 by the end of the year. Surprise factor on earnings, 7.5%. If these earnings continue to surprise, that would put us at 21.5 times forward earnings. But that's a surprise index based on earnings coming down. And then as they come down, oh, they surprise, but they do come down, oh, they surprise. They surprise from lowered expectations. So I am taking the initial estimate of earnings and applying the 7.5%. That's not how it works. Have a look at this. I'm going to bring this onto the screen. This is the S&P 500 Q4 24 bottom-up EPS. How the EPS estimate has changed from September 30th to November 30th. We've gone from 63.60, and look at the expectations. They've been coming straight down. So when you get a surprise, it's not off the 63.60. So it's not off the 263.36 that I'm looking at. That is the forward 4-quarter earnings now. That does drift downwards and then surprises. So the observation over the last little while is that the estimate of earnings always comes in too high and always has to come down, and then companies beat those lowered expectations by 7.5. I'm applying this 7.5 surprise factor to this earnings number before it drifts downwards. So the 21.5 is super aggressive. That is if earnings expectations do not drift down like they always do, and you get 7.5, we will only be at 21.5 times the forward earnings. Aggressive number still. We're over 23. If we think about, well, how would this drift down and then apply the 7.5, we may already be at 24 times forward earnings. But look at how it's drifted down, and look at how the market says, we don't care. We don't care. There's going to be good news ahead, and all the trade-offs. You say that tariffs will lower economic output. That bad news belongs to the bond market. It doesn't belong to the equity market, or it belongs to other equity markets, but not to the American equity market. I just see this being set up, this optimism into the end of the year, this unwillingness to consider any risk. Wait till we look at implied volatility and see how absolutely calm the market is on this one. If we look at all the weeks, this is the percentile, right? That if you ranked all the implied volatilities, all of them, there's the top 10%, the top 20%, and we looked at the observation. It is the 0th percentile, which means all observations of implied volatility over the last 13 weeks have been higher. Over the last 26 weeks have been higher. Over the last 52 weeks have been higher. For the last year, it's never been lower. Implied volatility at the lowest, at an all-time high, at 23 times forward earnings. Nothing to see here, folks. Nothing to see here. TLT, 0, 0, and 1%. Nothing to see here either, folks. Well, that's large cap. How about small cap? Not so good. Week over week, IWM, negative 1.22%, IJR, which is odd to me, negative 1.59. This is the profitable small caps. These are have a large amount of unprofitable small caps, down 1.22 versus 1.59. I had changed my short beta because I like to keep short beta so that I can have long beta somewhere else that's riskier. I changed my short beta a while back from large cap to small cap. And some people have been questioning the logic of that. Why you short small cap? This is their time to shine. I don't think so. And the market sort of doesn't think so either. Down 1.22 versus the market up 0.96. Had I stayed with short beta on SPY, I would have lost on my hedge. Now I'm gaining on my hedge and gaining on my longer positions. All-time high here, 242.56. That was from a couple of years ago. And IJR 126.73 from November 26th. We're just slightly below that, but to move in opposite directions. It's interesting. Let's look at some ratios. A CAPE ratio is greater than 38. Only the dot-com era was higher on the CAPE ratio, the cyclically adjusted PE ratio. The Buffett indicator, this is the value of the stock market using the Wilshire 5000 index, because that is every publicly traded stock in the US. Value of the stock market over nominal GDP, 208%. To put that in perspective, that indicator in the dot-com era was about 140%, and in 2007, 2008 was 110%. We're at 208%. And Buffett said, when you get above 140, you are playing with fire. Isn't that incredible? Now, to be fair on this one, the amount of revenue generated by the S&P 500 companies outside of the U.S., I believe, is at the highest level now, somewhere close to 50%, up from about 40%. That a significant amount of revenue comes from outside the U.S. So you would have market caps of stocks that would seem outsized compared to the GDP, because you are extracting some of the GDP out of other countries. So to be fair, the 208%, we have to take into consideration that as the years have gone by, the share of revenues that are non-US within the Wilshire 5000 have increased. Now, this is the Wilshire 5000. When I say about 50%, I'm really talking about the S&P 500, but I believe that makes up a significant amount of the market cap of the Wilshire 5000 anyways. Still something to be aware of. When we look at Berkshire Hathaway just building cash, huge amounts of cash, and the Buffett indicator being at 208%, well above both .com and the housing bubble of the knots. The CAPE ratio over 38, the forward PE over 23. You know, it is consistent with Buffett thinking this market is overvalued. I'm not saying that is what he's thinking. I'm just saying the footsteps he's leaving are consistent with that. For the SPY, implied volatility last was 9.4%. Last week was 10%. Under 10% volatility. TLT 11.1%. Equities are less volatile than treasuries. Put call open interest 1.91 down from 2.1. Less a drop in the interest in puts. For TLT 0.76 up from 0.67. More interest in puts on TLT, less interest on puts on SPY. So here we are. It is hard to say I'm all in and commit more money to a market that just seems to go in one direction no matter what the news is. Good news, market goes up. Bad news, market goes up. No news, market goes up. 23 times, 208%, more than 38 times, and you're in pretty bad company. Only the .com era was higher over here. And again, only 2 times has this actually been higher as well, the .com being one of them. So I am finding it difficult to put new money to work in this market. I do think that it is due for some kind of correction at least, but just every day just seems to be nope, no correction here, nothing to see here. You do have sell-offs that last sometimes as long as 17 minutes before you get these kind of V's. Usually you'd get these kind of V-shaped recoveries early in a stock market recovery. You get these V-shaped recoveries when you have multiples at 14, 15, 16. But to get to 23 times forward earnings and to still get these V-shaped recoveries on early morning sell-offs is, what is going on? Maybe the story is that, and maybe it's being believed across the world, is that there is no other place to be other than the U.S. You got to be in the U.S. market. But it's super expensive for other countries. You have a strengthening US dollar and a more expensive market, which means you have a depreciating, let's say, Canadian dollar, Australian dollar, British pound, euro. So it's becoming that much more expensive in Canadian dollars, British pounds, Australian dollars, and euros to buy this market. I don't quite buy it. But you can't argue with the excesses. Crypto on fire. And with the level of misinformation in that market, to be showing the excesses of what we saw during all of the free government money during the pandemic, the everything rally. Here we are again. I don't know if you're on the same page as me, but I am finding it hard at these levels to say, let me buy more. I have this eerie feeling that as soon as I say, okay, I'm in, we'll get a 10 to 15% correction, and I'll be like, I knew it. I will stay short IWM. I think that's just an obvious one at this point in time. Being that you have a significant amount that are unprofitable, tax cuts really aren't going to give that much of a boost over here. Regulations tend to favor large cap companies, so that if you have a decrease in regulations, maybe you'll get a shift from large cap to small cap, but I would think it would show up in IJR first instead of IWM. And look, this regulation is not going to happen on day one where it's all going to go away. You're talking multiple years of getting rid of layers of regulation. You just don't clean house on day one, and I doubt that you're going to get a tax bill on day one either. Maybe sometime in the second year you'll get tax reform. By the time you hit the third or fourth, you'll have enough of a decreased regulation that you'll start to see more entrepreneurial activity. Maybe in about a year, 1 to 2 years, I think maybe. Would be time to get into the small caps. If you have interest rates that keep coming down, if we avoid a recession, you do have tax reform, and you have a noticeable decrease in regulation over the next 1, 2, 3 years, maybe then IWM, but certainly not now. It's way too early. You are 5, 6, 7 quarters of earnings away from seeing any of these election promises show up in any of the earnings of these companies. So I will continue to get my short beta from IWM. I will continue with my long duration because I think if you do get a correction in the market, money will run into the safety of U.S. Treasuries. Okay, I want to end this week with a couple of fallacies we hear from the crypto crowd, statements that are simply untrue. I've said this before, the crypto space, I think, is premised on a lot of misinformation, and I think the success of crypto and the acceptance of crypto from a large part of the investing community is premised on misinformation and keeping people misinformed, or at least saying, I'm not going to inform an already uninformed crowd because their lack of information is my opportunity. But I'm just going to go over two really big ones. I have put some trades in place on IBIT and MSTR, and you can find them in the applied level in the portfolio construction module. I have started some experimental positions based on the crowd, not on the crypto itself. I couldn't care less about the crypto. I'm betting on the religion, not the God. So let's look at some fallacies. Number one, there is nothing backing fiat. That is untrue. A true statement is there is nothing backing crypto. And I can give you an easy thought experiment to prove that is true. To say there is nothing backing fiat is to ignore a balance sheet. A government has assets and it has liabilities. We always pay attention to the liabilities. But a government has assets. It has strategic gold reserves. It has strategic petroleum reserves. It owns a whole bunch of land. It owns a whole bunch of buildings. All of the minerals underground it owns. If you want to extract them, there are royalties that have to be paid. It owns all the air above your head. That's called spectrum. It owns all of that air above your head, and it has billions of dollars of that it can monetize and sell. So the currency is backed by the full faith and credit of the U.S. government, which owns a whole ton of assets. Well, a ton, more than a ton, hundreds of tons of gold alone. To understand what's backing currency, I'm going to make a broad sweeping statement, then I'm going to prove it. Every single asset in existence in the United States right now, every single asset that exists is backing the currency. Every single asset. So let me explain how that works. Originally, how money was created was somebody showed up with so many grains of gold. And if you had so many grains of gold, you bring it to a bank, and a bank would give you banknotes saying, well, what denomination do you want? You're going to be in the general town for a while buying stuff. And maybe they brought in $35 of gold. $35 of banknotes were created so that they can go out and purchase things. You could say that $35 in gold was backing $35 in notes. And these people went out and spent, and pretty soon everyone just started circulating the notes because, well, if I went to the bank to get the gold, I would just redeposit the gold saying, you got the safe, you guys hang on to that. More economic activity, more gold was mined, bring it to the bank, more notes were made. So the money supply was increasing at the rate of production of gold. It wasn't a constant money supply, it was increasing at the rate of gold. What was noticed was this: the faster the money supply increased in certain regions, the more vibrant the economy became, the better the standard of living in that environment. So it became clear that if you want a rising standard of living, you need an increasing money supply or an increasing source of money supply. Well, gold is only one thing. Gold is just one thing. What if it were silver? What if it were copper? What if it were platinum? What if it were palladium? What if it were oil? Right? All of these things, as soon as you bring them out of the ground, they suddenly have value. Let's take it one step further. What if it were labor? What if it were 1 hour of your labor that created something? Well, that is an asset in itself. So I can take some of my fiat currency and I can buy a house. Let's say at Bitcoin at 100,000, I take my $500,000 of fiat currency and I buy a house. Or I can buy 5 Bitcoin. I've bought some. Well, I'll be generous and call Bitcoin an asset, even though I think it's just a collectible. But let's say that you could buy a house or you could buy 5 Bitcoin. Here is how you can demonstrate, because both of them have $500,000 of value. Both of them have that. You've got your $500,000 in fiat currency is being backed by a house because you did pay for that, or being backed by 5 Bitcoin. Now turn off the power. I still have my house. Do you have your Bitcoin? Let's say that you have a nationwide blackout. I've still got my assets. Do you have yours? You have nothing. I want you to think long and hard about this. What is backing Bitcoin? Don't tell me, well, there's only 21 million. No, that's a limitation on the size of the supply. That doesn't tell me anything that's backing it. What is backing it? Nothing. What is backing fiat currency? All the strategic petroleum reserves, all the strategic gold reserves, all the minerals underground, all the air above the land, all the roads, all the buildings, all the national parks, a lot of the rivers, a lot of the water supply, every single asset that's owned everywhere. Because the money supply increases at the rate of GDP growth, roughly on average about 6% a year. I don't know where the crypto people get their 15% and 10% and 14%. I've heard ridiculous numbers, and you can look it up on Fred. The average is about 6% a year. This goes way back. The increasing the money supply goes way back to the time when you had kings and treasuries. And you had somebody who was watching the Treasury. And there was a time when the head of the Treasury was debasing the currency. In other words, not putting as much silver in the coin as they should. But what happened, what the king noticed over time is, with a certain amount of debasement, prosperity increased. With a certain amount of debasement. That's called partial reserve banking. With a certain amount of debasement, economic prosperity increased. We live in complex systems. Any economic system, any social system is a complex system. So in a complex system, you cannot maximize. You can only optimize, because a complex system involves trade-offs. So when you see a negative outcome, that's because we have more of a positive outcome. We've accepted the trade-off. Crypto wants to pick on a few negative outcomes and say, aha, we solved these negative outcomes, without understanding that, whoa, what are your trade-offs though? That if we substitute for your currency, what would your trade-offs be? The trade-offs of a fixed currency size would be significant. That you would, if you lived in a system, let's say that we lived in a system of a fixed currency. The blockchain today and the crypto today would be an unlimited currency, would be a currency that grows at the rate of economic growth. And it would be radical. It would be so radical because it would solve so many of the big problems of a fixed currency. You can't just say, well, it's fixed, it solves these negatives. Yeah, but these negatives are acceptable negatives because of the positives you get. You get this increase in economic activity. And that'll become clear when I talk about the second fallacy that crypto bros like to throw out there. Central banks print money and devalue the currency. Nope, they do not. They do not. And to demonstrate that, all you need to do is find a situation in which there are no central banks and the money supply increases. And we look no further than the free banking era. You brought gold to a bank. There's the gold sitting in the bank, and the notes are circulating. It didn't take long before the bank manager said, all this gold sitting there, it's doing nothing. We could earn some money on this gold. Why don't we print some extra notes to go into circulation, and then they'll come back and they'll deliver gold plus interest, and we'll make a little bit of extra gold. No one will ever know, because no one ever comes and takes this stuff. So they do. So instead of 100 notes out there, you now have 110 notes out there. The money supply just increased. The money supply just increased. And what happened over time, this became known as fractional reserve banking, is that the cities that had banks during the free banking era, that had banks that were increasing the money supply, had more vibrant economies, higher levels of employment, higher standards of living. They were just better places to live versus other banks which really held to, every note is backed by its share of gold. They grew at a slower rate. So this is the trade-off. You want a fixed currency? Well, then you have to expect a much lower level of economic growth, because the velocity of money is fairly constant. So if you fix the supply of money and you have a velocity, you pretty much fix economic activity. So as your population grows, you're going to have to accept more poverty and more unemployment. Not only that, with a fixed amount of currency, it is possible for a few people to control almost all of it. Now you get pre-1789 France, where you truly have the haves and the have-nots. And the haves were about 1%. And you had the 99%, because they pretty much controlled everything. If we had a fixed money supply in a competitive economy, those who were good at competing would get the money. And now it becomes a zero-sum game, because for you to get a dollar, you must get it from them. It's not enough for you to create value on your own and add to GDP and the money supply grow at the rate of GDP so that you can get some. You see, in this system, me having money does not preclude you from having it. But if the money supply were fixed, me having it does in fact preclude you from having it. And if I'm better at competing, I will, in time, own it all. And you will not buy a house, you will rent your house from me. And you will not ask for a certain amount of money. You will take whatever you can get because unemployment will be very high. Those are the trade-offs in any complex system. You can't look at the negatives of one system and say, tear it all down. You have to say, yeah, but that's the trade-off that we're willing to accept. What are the positives in response to that? Let's deal with this. Central banks print money. No, they don't. Central banks create reserves. They don't print money, they create reserves. Lending increases the money supply. They increase reserves, and then when the bank lends out money, they increase the money supply. That means when you show up at a bank and say, please, Mr. Banker, can I get a mortgage for this house? You are engaging in increasing the money supply. You are doing it. If you're against increasing the money supply, don't ask for credit. Get rid of your credit card. Only buy a house when you have all the money. Only buy a car when you have all the money. Only go to school when you have all the money. And you will not contribute to increasing the money supply. All of you do that. And you won't increase the money supply. If nobody demands loanable funds, you can't increase the money supply. All the central bank can do is increase reserves. Until they're lent out, it doesn't increase the money supply. You don't need a central bank in order to increase the money supply. What you need a central bank for is to control the increase in the money supply, because if you bring it back to these private bankers' greed, they'll lend out against 10% of their reserves, and they'll start making money, and they'll say, we can go to 15, we can go to 20, we can go to 25, we can go to 30, and then a rumor starts that there's not enough gold, there's a run on the bank, and the whole system collapses. You have a very fragile banking system at that point in time, and many people would lose a lot of their money. Many people would lose because the bank would now have to go seize all those assets and force sell those assets. You'd wipe out whole economies at a time. The central bank is not there to increase the supply of money. The central bank is there to control the increase in the supply of money, because left unchecked, private enterprise would increase the money supply on their own. We have witnessed it. Without a central bank, there is no limit to the level of greed at which one bank will continue to increase the money supply by saying, hey, we're 50%, we can go to 60, we can go to 70, we can go to 80, until it all falls apart. So I would seem to think that, listen, if economic activity is way too low and banks are simply not lending, banks everywhere are like, well, we don't want to lend in this environment, it's 20% unemployment. Well, you're stuck in a trap. How do you get out of that trap? You're in a suboptimal trap. You can't get out of that trap because all the individual actors say it's not in my best interest to do anything. Then you have a central bank saying, okay, we can help out. Let's lower rates really low. Let's see if we can't get the demand for loanable funds up. And hopefully that comes from business who says at these rates it's worth investing, it's worth expanding, let's do this, let's do that. That creates employment, and there we go. Because without it, what would you do? Now you have a system, let's say that you had your private banks that are just printing way too much money. All these banknotes floating around, but there's not enough supply, so the price of everything is just going straight up and up and up. Rapid inflation, because no one's controlling the growth of the money supply because you've left it in private hands. A central bank steps in and says, okay, that's enough of this, let's raise interest rates very high to decrease the demand for loanable funds. There we go. Now we have fewer banknotes being printed because banks are not lending this money anymore. That's what a central bank is there for, is to control the increase in the money supply that would happen in an unchecked system. What is crypto asking for? Stop regulating us. Let's get rid of all the regulations. And what are we cheering on for the Trump administration? Yay, lower bank regulations. And let's get rid of an independent Fed as well. Keep in mind, everything has a trade-off. Every time you say, well, let's push on this lever because this direction is good, you have to accept the other direction on something else is bad. You want less regulation in crypto, you're going to have more people lose money. You're going to have less protection for the consumer if that's really what you want. So we've gotten rid of the first statement, nothing backing fiat. There's a lot backing fiat. There's nothing backing crypto. If we think about it in terms of intrinsic and extrinsic value, they both have extrinsic value. Extrinsic value is the value we place on it, period. It has value because we place value on it. But fiat has intrinsic value. Crypto has no intrinsic value, only extrinsic value. So take it both are the same. I'll take something that has some intrinsic value over nothing. Central banks do not print money, they print reserves. Banks print money by lending to people like you who say, please, Mr. Banker, lend me some money. Every time you swipe your credit card, boom, you're the problem. You're the problem. Stop getting loans for your education. Stop getting mortgages. Stop getting car loans, and you won't have this problem. You'll have a bigger problem, though. Do you see the trade-off? Right? Let's deal with this other part, devalue the currency. Wrong unit of analysis. I think that almost any economics graduate student would recognize that right away. It's the wrong unit of analysis, the currency. The appropriate unit of analysis is 1 hour of your labor. Because what is the currency? It's a medium of exchange. I produce an hour of labor, but I want some butter. I don't want to have to walk around to a butter manufacturer and say, could you use an hour of my labor? I want to be able to sell an hour of my labor to anyone, get some of this currency, and then use that currency to get some butter. So the true value that I would be looking at is the value of my labor, right? If your purchasing power is diminishing, blame the value of your labor, not the currency. Blame the value of your labor. To do a quick test on this, if we go to the minimum wage in 1970 versus the minimum type of bread that you can buy, 1 pound of bread. Minimum wage was $1.40. A loaf of bread was 25 cents. You could get about 6.5 loaves of bread an hour. Fast forward to today, a minimum quality bread, the same bread, call it Wonder Bread, the white Wonder Bread, $2 for a pound. $17.50 is the minimum wage here in the province that I'm in. That is 8.5 pounds of bread per hour, from 6.5 pounds of bread per hour. It's an hour of labor that is the unit of analysis. The currency is just the medium of exchange. So to say, oh, a dollar doesn't buy what a dollar used to buy. Yeah, but your hour of labor buys so many more dollars than it used to buy. It's the hour of labor that is the unit of analysis, not the currency, the hour of labor. Now, if you find that in your life that it's getting harder and harder for you to make ends meet, prices are going up and up, let's say your wages aren't keeping up with inflation, then you have to blame the value of your labor. Maybe the value of your labor is what you let go. You didn't put enough in to the value of your labor. Maybe that's the problem, because the economies do change. You know, coal mining is not really a job of the future. Truck driving is not really a job of the future. So if you put in all your effort into truck driving and now you're finding it harder and harder to make ends meet, well, that's because an hour of your labor isn't worth anything. Don't blame the currency. Blame the value of your labor. So I think we've made quick work of this. There is lots backing fiat currency. There is nothing backing crypto. Central banks do not increase the money supply. They control the increase in the money supply that is created by banks lending to you. And the currency does not devalue. It's the wrong unit of an analysis. 1 hour of your labor is the unit of analysis. So if, again, you find, oh, the currency just devalues. No, maybe your labor is just devaluing in the marketplace. How fun was that?